When government need roads, schools or hospitals, they usually use tax revenue. But in some countries, companies are allowed to build infrastructure instead of paying part of their tax. This system is called infrastructure tax credits, and today I want to explain how other countries use it and what Papua New Guineans can learn. An infrastructure tax credit allows company to offset part of its tax obligation by directly funding or building public infrastructure, such as roads, bridges, schools or health facilities. The idea is simple: development now, tax relief later. But how this system is designed determines whether it builds the country or quietly drains public revenue. In countries like Australia, infrastructure-related tax offsets are tightly controlled. Projects must be approved before construction begins. Costs are independently verified, and once built, the infrastructure becomes public property, not private assets. No approval, no tax credit. In Canada, similar mechanisms are linked to regional development goals. Tax authorities and project approval bodies are kept separate to avoid conflicts of interest. Most importantly, there is strong public reporting. Citizens can see what was built, where and at what cost. In resource-based economies like Chile and Peru, infrastructure offsets are mainly used in remote or under-deserved communities. They are limited in value, time-bound and reviewed regularly. These credits are treated as temporary policy tool, not a permanent entitlement. Across these countries, there are common principles: clear legal limits, independent valuation of costs, strong transparency, and a clear rule. Infrastructure first, tax benefits second. In most cases, infrastructure tax credits are the exception, not the normal way of doing business. In Papua New Guinea, the concern is not whether infrastructure tax credits are good or bad in theory. The real question is whether safeguards are strong enough to protect public revenue. Without strict caps, independent valuation and transparency, the risk is that tax credits begin to replace revenue rather than complete development. Infrastructure tax credits can work, but only when rules are clear, limits are enforced, and the public can see the results. PNG should place stricter laws on infrastructure tax credits, or should the system be reviewed entirely? Let me know your thoughts in the comments.